Welcome back to Squawk Box. Rick Santelli here live at CME HQ with the breaking news of the morning. Big news. CPI, the big inflation number for September, hitting the wires. Expected to see a headline up 0.1%, comes in up 0.2%. If you strip out food and energy, up 0.3%, which, of course, equals our last look. To find a bigger number, you have to go back to March when it was up 0.4. But do keep in mind, June was up 0.1, July was up 0.2. So this has been running a bit on the warm side. Now, if we look at year-over-year numbers, 2.4, hotter than expected, but 0.1 cooler than the rearview mirror, and it continues the streak of these numbers year over year on the non-core moving lower. And if you look at 2.4, just like 2.5, it comps back to February of 2021. Now, if we look at what's going on with respect to year over year core, which starts to get into some very important numbers here, this one's warm as well. 3.3. 0.1 warmer than expected, 0.1 warmer than the rearview mirror. It equals June, but of course the last 2 months have been 3.2. Now, finally, if we look at the indexes, and I think the indexes are very important, the index for the headline number, 315.301, another all-time high. If you look at the core, 320.76, another all-time high. Now, let's look at initial jobless claims. Some surprises here. 258,000. 258,000. That's going to put a little potential downward pressure on interest rates. The last time we had a number in that category, you're looking at June of 23, where it was 261,000. And finally, yes, it's the 18th consecutive month over 1.8 million on continuing claims. And just for the record, the last time we were above 1.9 million was November of 21. We come in today at 1,861,000. That would be the warmest going back to the third week in July. So to summarize, it certainly seems as though the inflation numbers pretty much across the board were either as expected on one count, but pretty much warmer on all counts. And initial jobless claims definitely had a little pop there. So before the number, we were hovering right around 404 in a 2-year. We have dropped rather dramatically. We're now briefly under 4%. But if you look at the longer dated side, it moved from about 408 to basically 406. So it moved down as well. What's notable about 10-year is that yesterday was the 6th consecutive session that the high yield was higher than the previous day's high yield, all consecutive. So we want to monitor today, and today it already happened. We have traded above yesterday's high yield. We have high yield today of 410. The high yield yesterday was a whisker under 408. That means 7 in a row. Why do I bring this up every day? If you're a technician, that's a real momentum builder to higher yields, lower prices. Becky, back to you.
And Rick, what about that auction sale you were pointing out yesterday? You made the interesting point that we'd see if traders are more concerned about locking in some of the gains maybe they've seen at this point, or maybe more concerned about that upward trend continuing.
Yes, I think what we are going to see is, and we do have an auction today, reopened 30s, $22 billion. But I think we learned a lot over the last couple of auctions. It certainly seems as though certain categories have gotten a bit excited. Yesterday, it was all about indirect bidders. For the 3-year, it was about direct bidders. These categories show me that there is a little bit of nervousness out there regarding the U.S. economy, how the Fed has anticipated how the rate cycle will go. And yes, I think there has been some profit taking, but I do think there's more of a reluctance to fade the notion that long duration rates like 10s, 20s, 30s, even 7s to some extent, are going to be a bit more excited. Many believe it's the political season, and that subset believes it's all about debt and deficits, and how neither candidate seems too worried about trying to overspend to get more votes.